There are three things every trader and investor who wants to make money needs to know. One is intercorrelation. We're going to look at Doge as a specific example, but the chart that you look at is unimportant. This will apply to any chart. The second thing that you need to know are the structural levels, or where price is likely to reverse from and reverse to. It's very important. Intercorrelation and interconnection, as well as structural levels, are very important, but one of the more important things is to know how to get out of the panic and blame zone into zone 3 and zone 4, which is the making money and keeping money rule zones. This requires a shift from certainty into probability and rules. We're going to discuss that as well inside this video. If you do these three things, I'll show you how it can all work out. Just have a look at the video Profit Skills. It's really, really valuable. Another incredibly informative and educational video is how to trade dips. That's a ripper as well. Let's get into it and let's run the numbers. When you're new to trading and investing, you probably don't really realize how complex financial markets are, but markets reward knowledge and penalize the lack of it. Therefore, you must know what you're doing. As an example, say you were in the crypto space and you wanted to invest or trade in Doge. You might just, if you were just starting off, just look at Doge and say, oh, these are the levels. I see Doge took a bit of a hit and it looks like it might be recovering. And somebody told me on social media or YouTube or somewhere that I should buy Doge. So I'm just going to randomly and blindly buy it. And of course, I'm going to buy it at market. This is a big problem. You do not want to do that. Now, what influences Doge to move? If you said the news, you're actually incorrect. Doge is moved by Bitcoin's price behavior. I'll show you how. Long-time members of our community understand that no alt can escape Bitcoin's gravity. If Bitcoin is coming down, what's going to happen to Doge and the rest of them? They're going to come down. This is how the crypto market works. But you can say, but Ken, sometimes Doge is going up as Bitcoin is going down. This is another thing that traps retail, because retail expects a one-to-one relationship. If Bitcoin goes up, Doge must go up. If Bitcoin goes down, Doge must go down. It's not like that. What you're looking at is the basic overall association. For example, if I pop down to the 15 minutes, you can see there's a fairly good association between Bitcoin and Doge. If I go back away, yeah, that's quite a good association. This is called a directional correlation. A lot of people are highly unaware that these directional correlations exist, but once you see it, you cannot unsee it. It's not going to be 100% of the time. Sometimes you'll find that one thing goes up as another thing goes down, but you can see on average, and that's what you need. The probabilities favor that these two will move together, and this is the case for all cryptos, not just Doge. You say, okay, what you're basically saying is if I want to get into Doge, I need to look at Bitcoin. But what moves Bitcoin? It's an excellent question. What tends to move Bitcoin are the main markets, especially the US market. Here you see that blue line. That is Bitcoin. Underneath it is the S&P 500. S&P 500 and Bitcoin tend to move together. And you will find from time to time they do go out of alignment with each other, and that's nothing to be concerned about. Bitcoin operates 24 hours a day, 7 days a week. It's pretty hard working. The stock market is quite lazy. It spends most of its time asleep. Well, it needs its rest. But you can see that there's a lot of directional correlation. If you're looking at Bitcoin, which is trading 24/7, and you're seeing Bitcoin come up, that may indicate that the main markets are about to come up as well, especially if Bitcoin has been going down. But the reverse also applies. Therefore, we need to look at something else. They're the futures. Global stock markets are pretty lazy. They're only open between very limited hours, almost like the banks. And when you see The futures are trading much, much longer than the stock markets are. They're outside of hours trading. And what you notice here, the S&P 500 futures has just gone ballistic. The NASDAQ futures has come up. The Russell and the Dow are just pretty suppressed at the current time. But you might notice, as Bitcoin was coming down, what did the main stock market do? The S&P 500, it was coming down. A lot of people think that crypto and the stock market are governed by the news. It's not that case at all. In fact, it's the other way around. The news is governed by price action, and people just manufacture stories to relate to it. What about if you're an investor in non-US markets, such as the Japanese market inside the Nikkei or the ASX inside Australia? Well, the key is to look at the main markets, to look at the US markets, because that's where all the money is. These are the highest liquidity markets in the world. If the S&P 500 is going ballistic, expect the ASX to do really well when it opens. And expect that to follow through to the Japanese market when it opens. Stock markets open at different times all around the world. But Ken, I don't care about that. I don't care about stock markets. I only care about my meme coin. I want to follow my meme coin, and only my meme coin. Well, get prepared to lose a bucket of money. If you don't know how Bitcoin is moving, you're in a lot of trouble. Directional correlation is the first thing that you want to look at, and that's why we do the cheat sheet. The cheat sheet is available from CTKSMethod.org, and it's absolutely free. Just for a little bit of fun, I'll change Doge to a 5-second chart. What do we notice here about the directional correlation? This is between Bitcoin and Doge. Well, it's fairly solid, isn't it? This is on a 5-second basis, so it gives you an understanding that you really need to look at what Bitcoin is doing if you're into any other crypto. You could say something like this: oh, Doge is coming down. I wonder why. Well, could it be because Bitcoin is coming down? Oh, okay. And why is Bitcoin coming down? Oh, could it be because the S&P 500 futures are retracing after that monster move up? The answer is yes, yes, and yes. If you're new to the channel, a very warm welcome. And just a little bit about me. I've been inside financial markets for nearly 40 years. I have a degree in finance and an actuarial science and statistical lecturing background. You could say I'm a numbers guy. In addition to this, I'm a core developer of TA, or technical analysis, and I've written books on finance. One thing to remember, the chart you're looking at is not the chart you're looking at. If you're looking at Doge and seeing that it's coming down, just assume that the S&P 500 futures are coming down, the NASDAQ are coming down, the Russell and the Dow are coming down. And you can see that's exactly correct. Your first step is to understand directional correlations as they exist across the markets, because they're really important. You actually can't make money without them. And you can see what's happening right now in real time. The Dow, the Russell, the S&P 500 and the NASDAQ futures are coming down, and that's putting negative price momentum onto Bitcoin. Bitcoin, as a result, is saying, hey, Doge, come with me. Just hang out in this negative area. And that's what's happening. So that's step number one. What's step number two? Once you've got the directional association or correlation in the bag, you need to know what the structural levels are. Structural levels are not random levels. They're drawn by international standards. What you will typically see is a lot of people drawing just lines due to recent indicative price action. And I'll tell you how you can spot those people. They are everywhere. And it's just a very bad way of doing things, because you're creating a story out of price. They'll just look to the current price or very close to it. In fact, they'll just typically look to the low or to the high, and then they'll create some kind of story. Oh, you see my line, it comes down here, it bounced perfectly. But in order for it to bounce perfectly, that point would have had to exist before the line was drawn. You'll understand what I mean when you see these people. You don't want to follow anybody like that. They simply don't know what they're doing. And the majority of people do recent indicative price. RIP levels will RIP your funds. Instead, you need something else. You need a standards-based process where you look across all of the data to try to find out where the real structural levels are. And structure, the word structure is really important. People can throw around, oh, this is a structural level, but it's not necessarily a structural level unless it marks up all of price history. In this case, Bitcoin has been trading since 2009. That's in excess of 5,200 days. I'm just going to pop on the indicator so you can see where the actual true structural levels are. A structural level is a very important level. It's drawn through all of price history, and you notice it's not just one level. What you're specifically looking at when you look at this is not one line to control them all. It's not the Lord of the Rings. This is structure. And when you see a confluence of different structural levels that are above price, they're called resistance levels. Structural levels below price are called support. When you get an accumulation or congregation of support levels, that's good. That's what you want, because price is likely to come down to this level and reverse back to the upper structural level. This is what happens all the time. If you have a congregation of very heavy structural levels, you would anticipate it coming down into the next structural support level. If that doesn't hold, it's going to the ones below it. It's a very simple rule and very profitable. The thing to understand, this structure is drawn before price prints. Now, what does that mean? That means that we knew this structural level existed way before price was here. We know these structural levels exist as well. They're not drawn in relationship to the current price. They're drawn in relationship to all price. That actually raises a really good question. If you see, for example, a line that somebody draws and they say you only need one line, this is a very newbie way of thinking, and that may sound strange because some of the people saying this have been inside financial markets for a decade or so. But when you get to around 4 decades, you realize that just one line will not help you because you may have the wrong line. It's kind of like the line that you don't draw is the line that costs you a lot of money. So when people say you only need one line, well, what happened when that line gets invalidated? Where's the next line? That's why you need to see where the structure is ahead of time. Now, what has Bitcoin actually done here? Because we're looking at the Dogecoin chart, aren't we? Because we know that Doge is moving just like this. And we're also looking at the futures of the S&P 500 and NASDAQ, the Dow and the Russell, because they also move like this. We can see that the structure inside Bitcoin had support around that 63,100. It also had resistance around that 65,300 mark. So what did it do? It couldn't get above this 66,800 level of resistance. So it came down through one structural level and got caught on the second safety net. One thing to understand with structural levels, they're not brick walls. They're safety nets. They're elastic. They're gravitational areas. You can see, and the people inside the service, just please make sure you watch that service video. I talk about passes and fails, and it's really very, very powerful. You can see there's a lot of failures happening up here on this structural area, and that put the lower structural support level into play and the lower one below that. Always think in terms of clustering your support levels because after all, they're elastic. They're not brick walls. It can pass through one and go down to the next one. If you want to read charts, you must understand first how they all intercorrelate and interconnect together. Then the most important thing is to understand the structure, because the structure is the thing that causes the price waves or the price momentum. When you have a sell-off from deep structural resistance levels, you can expect it to go down a couple of levels because after all, they need to draw in all the leverage shorts to come back and to push through these levels. In fact, they may draw in so many shorts that they may flip the market down towards the negative side. So understanding how price is relating to these different structural levels is critically important. And don't get conned. One line does not control anything. It's just a fallacy. I wouldn't say this if I was not a victim of that kind of thinking in the past. In the past, I thought a similar way, and that's what experience does. If a person is inside, or say a person is playing a sport and they've played at professional level for 5 years, they're going to be pretty good and they're going to know a lot of knowledge. What about 10 years? Well, they're going to be much better. 15 years, they'll know more. 20 years, whoa, they'll know a lot. 20, 30, 40 years, the more that you be in a specific area, the more knowledge you're going to pick up. And this is the same with everything in life, our jobs, our hobbies, just everything. So what I'm sharing with you is an accumulation of a lot of money going into the market and a lot of losses for not getting the right answers out of the market. Now, what do I mean by that? When you make a loss inside financial markets, always create a rule for yourself. This is a rule that I've created for myself, and I share it inside the masterclass. Markets demand, now this is an interesting word, they demand the tuition fee. It's a tuition fee, a learning fee of losses. If a position goes against you, you didn't catch on to something that the market was trying to teach you. There's no point at all in taking the loss personally. In fact, if you do, you're probably inside zone 1 or zone 2. These are the lose money rule zones. A lot of people talk about having diamond hands. Well, that's a pretty good thing to have, but you really need a diamond mind. Because when your mind is just rock solid, what you're doing is you're not gambling, you're not panicking, you're not getting emotional, you're not getting jealous of other people's success. You're actually thinking from a different perspective. You're thinking from a perspective of patience and from rules. And that takes a lot of learning and courage, because the people that get inside financial markets are inherently very, very smart people. They're not used to losing. In fact, when it comes to finance, the top of the top get involved with finance because it's so complex and they're drawn to it. But then they're shocked when they actually get into the market. The textbooks kind of don't work because price action is emotional by nature. What people want, and especially if you're a really good student, you're used to getting very good grades and you want certainty. You think there's a right answer for everything. Not inside the markets. Your certainty will create terror. You actually need to move out of zone 1 and zone 2, which are the certainty zones, into zone 3 and zone 4, which are the probability and rule zones. But Ken, I thought it was just intercorrelation, and now you're telling me it's levels and mindset? Oh no, I just want to go to the casino and gamble. If you want to have fun and throw your money around, of course, go for that. But if you want to make real money, what you can do is you can go back into the videos and have a look at profit skills. I share my trades. I show you how you can lever up and do incredibly well. And I always go at spot. I don't use leverage, but if you have a smaller account and you know the rules, you can do so. But if you don't know the rules, unfortunately, you're not going to be making money. You're going to be losing money. Also, I recommend that you have a look at how to trade dips. If you've seen these videos before, have another look at them. They're really good, and you'll end up picking up even more value. We've literally just scratched the surface of how you need to go about doing things inside the market. And if you're new inside the community, please reach out and just say hi inside the comments. You will see that we have the most beautiful community on YouTube. We're all very positive people. We're a community of learners because we understand that your learning is your earning. If you focus on your learning, you're going to do so incredibly well. I hope this has helped you to gain a bit of a perspective on how you can go about looking at financial markets. And please be aware, scammers impersonate everybody they can on social media. I do not manage other people's money, and I never have. I think that the most important thing, your learning is your earning. That's what you need to go after. And the links of the things that I'm involved with are just on the About page, just in here. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again in the next video. Bye for now.